Yeah, welcome and thank you for tuning in. My name is Kelly Raymond and I'm a Forex trader. But seriously. Yeah, today I'm going to be talking about top 10 worst Forex trading strategies. If your strategy is listed here, I'm probably going to pick you up and bash your head in today. Not because I want to, but I need to open your eyes. You need to wake up and smell the coffee. If your strategy is here, you need to switch it up. You need to change something. Again, I'm going to be talking about top 10 worst Forex strategies. And I'm going to show you examples of why I call it the worst Forex strategies. Number 10 worst trading strategy is arbitrage trading. What is arbitrage? Arbitrage is buying currency A against currency B using the price of currency C to make a profit from currency A. Sounds complex? Yes, it is. It's just like buying from three shops, buying different items from three shops, buying from here, selling to this, and then picking from here. It's more like hedging, but in a way where you hedge out a currency and you hope that is a slip in price and you make a profit. What they do is make money from slip in price. That could be calculations, that could be computer calculations gone wrong or something, or a slow broker trading against the faster one. Price differences from two different brokers can also be used as arbitrage. While on some brokers it is illegal, other brokers will allow you to trade that, but the opportunity, the chances of you getting trading opportunity is slim. You could go 3 months without a single trade, but most times some of these arbitrage opportunities happen especially during news release. I'm talking about NFP, and sometimes it happens with the interest rate decisions, so that is when arbitrage traders are able to make money. It is not consistent. You can't always make money. Most arbitrage traders don't even do it manually. They use softwares to do that. I have actually coded an arbitrage strategy and tested it over the long run. I discovered it won't make money. It's not profitable. So it has got to be one of the worst trading strategies to use. Now, I'm going to talk about number 9. Number 9 is counter trend trading. I really do not understand why people would classify themselves as counter trend traders. I think the same people who trade the trend sometimes go against the grain and decide to open positions against current trend, trying to catch the pullbacks or something like that. But the truth is, we all hope to make a profit when we trade in the original direction of the trend. How can someone confidently claim they are counter trend traders when they trade against the trend? Come on, trend is supposed to make you money. Trading against the trend is supposed to make you lose money. That has got to be a misunderstanding. I think the appellation probably doesn't describe them properly. Most of them misuse indicators such as Williams percentage R and the marker, Fibonacci retracement, and all of that. I think they're just hoping to be lucky that each reversal or each pullback is actually a reversal, and chances of that happening is just 10%. You can go a whole year without having a single profitable trade if you're a counter trend trader. So stop it. Number 8. Yeah, this is one thing a lot of people do. A lot of Africans do this. And then, people are hungry and looking for quick bucks. I'm not trying to bash Africans because I'm African and I know how it is. It is number 8, straddling high impact news. Yeah. I'm sure you must have read about this somewhere, and I'm pretty sure you must have heard the term "don't trade the news." Well, I know a lot of people who trade high impact news anyways. They don't care. What baffles me with these traders is how little they care about the actual outcome of the data released. They simply sell stops, buy stops a few pips above the current price just shortly before the news, and sell stops a few pips below the price just before the news. And they hope to catch the spike and book a profit. While that makes sense, I like to watch the market during high impact news. Yeah, I really like it. Not because I trade the news, but because I simply look forward to a good laugh at someone else's expense, especially when the market does the old and reliable whipsaw, taking out both buys and sell, hitting their stop losses while at it. The worst is that those who trade the news barely utilize money management. They don't even use stop losses. Those who trade the news would naturally go for brokers with extremely large leverages, right? Because they can put in $100, $200, $300 and open 2 lots trades. So just a few pips against them and the account is wiped out. They don't care. It's more like gambling, right? Yeah, I think most of these people came with a gambling mindset to the Forex game, and they come into the Forex market with all sort of expectations. It is hurtful to see people lose money that way. As a matter of fact, they go all in. I do admire the courage, but I do not envy their ignorance. Come on, I don't envy the ignorance. What they do not know is that scheduled news are not news. No, scheduled economic data is not news. Prior to the NFP week, experienced traders would place a trade on the side of the consensus, right? The market analyst would naturally expect a figure. Yeah, and they will state the figure on the economic calendar as consensus while they wait for the actual result to come out. So if the analysts are expecting a lower figure, they'll place a buy against the currency. So if the data comes out and it's just as bad as they expected, prices will go down further and they'll book a profit. It is called buying the rumor and selling the news. That would have been a nice strategy, but I'm not here to talk about strategies. I'm here to bash the top 10 worst strategies. What retail traders see on the day the actual data is released is the reaction of the big guys, which includes closing their positions when they are wrong or opening new positions in the right direction when they are right, or vice versa. These actions actually move the price either way because they have billions of dollars to put in. Now, since they already know the levels where the orders of news traders will likely be clustered, they will simply trigger all of them by placing huge trades against them. So for companies who have 300 billion to play with and they'll just have about 6 to 50 billion, that would move the price. What people don't understand is these central banks could actually move the price. They want to make money. What they will do, if most retail traders orders are here, their buy stops are here, if most retail traders buy stops are here and sell stop, what the market maker would naturally do is simple. They will take prices during the news. When the news release, they will take prices up this way, move your move you into the trade. That is if your broker's spread doesn't get you into the trade earlier. They'll move the prices up a bit, hit your buy stop, yank it right back down, hit your sell stop. They move about 3 to 5, 7 to 8 pips, and then come down here, do a bit of that as well. Come back in, hit your stop loss. They don't care. So it is really surprising to see retail traders lose their money because they don't understand all of this. Number 7, stochastics, oscillator, and commodity channel index, which is the CCI. That is number 7 worst trading strategy. Some people like to use other indicators with the stochastics and CCI. I really can't figure out why people would do that. These indicators were not designed for the Forex market. They were specifically designed for the commodities and the stock market. Believe it or not, there was a time I delved into the world of binary options, and these indicators were very popular. Almost everyone who decides to showboat and show some of their earnings would have stochastic or the CCI on their charts. My problem is quantifying noise. I mean, just with binary options. I don't do that anymore because I just tested it. I just wanted to see what the fuzz is really about. I was trying to use the binary options to hedge my risk. Most binary option providers or brokers don't allow you to hold trades for longer than a day, and when they do, your payout usually is next to nothing. So it doesn't make sense. Retail traders would often use stochastic oscillators to determine overbought and oversold conditions in the market, and it barely works. As for CCI, the name has told you what it was designed for. It was not designed for the Forex market. It was designed rather to trade commodities. In case you don't know what commodities are, I'm talking about corn, cocoa, flour, wheat, cotton, coffee, and all that. Those can be traded. The CCI will work best if you trade those instruments. The CCI would really shine. Number 6, the MACD. People love the MACD. MACD isn't a bad indicator, right? MACD could have been one of the greatest indicator ever. One problem it has, it is slow. It is so bad that if it were your personal driver, you would always arrive at events late. No matter how you tweak the settings, MACD will always be late because you all know it calculates price actions from the past. And secondly, it uses a moving average. So go figure. How would you feel if you get a signal 3 days to enter a trade after the actual move happened? It must suck, right? Now imagine having a couple of more indicators such as the RSI, the stochastics, which are already lagging indicators, and using those indicators as a filter for the MACD. I've seen people do that, and it's annoying. No, seriously, I feel so much pity for people when I see them trading with MACD with a couple of other indicators such as the RSI, the stochastics, the CCI. Come on. Losses. You could have a few wins. Yeah, it's possible to generate a few wins, a few winning trades, but over the long run, people run into losses, a lot of losses. And some people wonder why they haven't made money from Forex. It is their mistakes. Misinformation. I guess the internet is ripless with information on how to use the MACD on the Forex market. It was not designed for Forex market. Number 5, reversals. It sounds like picking tops and bottoms, but it isn't. While this may seem like calling tops and bottom, it is completely different because some retail traders think they have an edge over the market trading reversals, and they trade reversals using, indicators such as the Williams percentage R, or the demarker, or the relative strength index RSI. What is worse is that they try to use these indicators by setting conditions called the overbought and the oversold. I think that is nonsense. How can something be overbought when there's an endless supply? Nah, it doesn't work. These indicators were designed for different purposes entirely, and trying to use them to trade the Forex market would only amount to losses. Simple as that. Number 4, tops and bottoms. Yeah, tops and bottoms. Some people try to pick out tops and bottoms. Trends can go for years. For the past 5 years, the cable GBP USD has been on a free fall. I'm just wondering who will try to catch it. This strategy shares the same attributes as one of the oldest and the most reliable price action strategies ever used in the market today. However, as retail traders, we often overcomplicate things for ourselves to the point where the best trading strategies become pretty useless. They can't even help us at this point. The problem with picking top and bottoms is that you will never really know when a pullback turns into a reversal. And I'm sure most people would like to bet on this. They would like to bet on reversals. I mean, trying to pick out the bottoms when the trend is going down. It really is no use. It wouldn't work. Trends can go for 3 to 5, 7 years. So I think it is better to just allow the trend form before you hop into it. That's my solution. Number 3, the M's and W's. I see a lot of people chasing the M's and the W's, and I quite don't understand. While that is also part of the harmonic patterns, I have decided to make it a separate strategy on its own, simply because people specifically seek out M and W's on the chart. They want to find that pattern. The market will draw M's and W's a lot of times, but most times, until it is formed, you will never know. Because what looks like an M could become a W. And it could happen a couple of times every single day. Imagine the number of losses you would have made trying to chase M and W's. While it may make sense, I think it's a simple break and retest, and in some cases, just a mere stop hunt by the broker or by the market makers. Second on the list, the harmonic patterns. Yeah, let me talk about that for a second. When you look at a price with the intention of seeing patterns, surely you will find patterns forming, but they do not hold any value. If you're trying to look at the Forex charts and you're trying to figure out what pattern you're seeing, any pattern that comes to mind will start to form. Your mind might be playing tricks on you. I'm not saying someone somewhere couldn't have had a name for all of this, just to have a better understanding of what it's doing on the market or what it's looking at. We could be looking through the same window and we'll see different things. I could focus on a guy riding a bike and you would focus on the babe walking down the street. If I'm looking at the chart, what I see is not going to be what you're focused on. So if you're trading harmonic patterns, I can see why you lose a lot. Number 1, Bollinger Bands. Bollinger Bands is not a bad indicator. But the problem is most people confuse Bollinger Bands for trending indicator. It is not a trend following indicator. It was not designed to follow trends. It was designed specifically as a volatility indicator. A volatility indicator. It was designed so you could figure out if a particular instrument is volatile or it is quiet. Bollinger Bands are designed to tell you that. Nothing more, nothing less. I see people trying to add in some filters to Bollinger Bands to generate signals, but I can assure you it is not designed for that. So you're trading with the worst of the worst, or you're trading the worst strategy ever. And that is why it made number 1. I actually traded these strategies for a long time, and I back tested these strategies. What I did is simple. I created trading robots to trade these strategies, and trust me, I'm a trader and as well as a programmer. How I'm able to come up with all of this strategy is logic and back testing. Logic and back testing. Back testing to support logic and logic to support back testing. When I back test strategies based on separate rules, different rules that I've seen over the internet, and I tested them over and over again. Each and every of this strategy, I tested them for a period of 5 years. Now, it's not like I waited for 5 years to test all of this. No, I don't have that time. I created these indicators and EAs, which is trading robots, and algos to trade these strategies. What I simply did was to back test them, and I realized they don't work. They really do not work. So that is why I call them the worst of the worst trading strategies. Why did I go into this research? Why did I do that? because I know a lot of new traders and a lot of old ones get caught up in the world of strategy mining. They go strategy mining. One of the first things you do in Forex is when you lose a lot of money, you start to question your strategy. So I want to make that simple for most people who go into Forex trading. Forex trading is simple. It doesn't require so many different strategies. You don't need too many strategies. You only need one solid strategy. Unfortunately, these 10 strategies are not what you need. They are not even close. You don't need them. They are barely profitable enough for you to survive in the Forex market. So I'm telling you all of this so you wouldn't have to find out the hard way. Yeah, so that is the end of me showing you strategies, explaining those strategies. But because I have the benefit of hindsight, you may not have that opportunity because you have money on the line and you're trading with indicators that your Forex mentors must have told you to use. Sometimes these guys don't even use these strategies. Sometimes they don't even trade, but they'll tell you to use these strategies hoping that you could make money. If you're using any of these strategies, I think you need to revise the strategies. If your strategy is one of the ones that I've mentioned here, you need to dump them. You need to dump them and look for new strategies. I come out here with new strategies every single week, and I think I'm going to stop after some time because I don't have too many strategies in mind anymore. I like to keep trading simple, but if I find something that I think is an edge over the market based on my back tests, then I can bring it forward and tell you, oh, this indicator is good, or this combination is good. I usually don't combine indicators. I prefer to trade price action, and that is how I have been trading, and that is what I like to teach you guys here. I create indicators and I tell you how to use them and the strategy behind them. I don't just create indicators and just hope that you make money out of them. I create indicators and I show you how to use them. That being said, thank you for watching the video. If you like this video, please leave a thumb up. Yeah, please leave a thumb up. If you hate it, please leave a thumbs down. Yeah, because I just bashed some of your indicators, so leave a thumbs down, whichever way. I appreciate it because you really watched to the end. And if you're not a subscriber and you would like to be informed about real stuff on the Forex market, and you also want to learn price actions, you want to learn about indicators, or you would just want to learn about strategies that work for me and my Forex journey and what I have done in the past and what I'm doing, subscribe below, yeah, by hitting the subscribe button below. Yeah, also hit the notification bell. If you like this video and you want to ask me any question, please leave a comment in the comment section below, and do have a great day.